Hi everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, topics. So we are going to dive right in, see what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. I dive into all of these topics. We just had a good question and answer session going over kind of my strategy to some extent on returns of previous bull market and kind of my strategy of what I'm deploying for the current bull market. And if that's something that you're interested in learning, strategies, individual companies, why I'm going into these companies, it's something to join and listen to and learn from. So we've got a May Day coupon code that is active right now if you want some savings for that. It's 50% off just the first month. If you want to try it, you can always switch to the yearly membership and get further savings if that is what you're interested with that coupon, MAYDAY. So HZ, the bubble is the biggest of them all. Tech at an all-time high versus the S&P 500. I know HZ on Twitter is pretty bearish. He comes out with bearish things on a daily basis. But with the way that I view this, if you look at these particular two standard deviation hits, bottom of a commodities bull market, so bottom of the commodities market here, bottom of the commodities market was not at this exact, well, yeah, no, it is at that exact moment because that's late 90s, early 2000s. And then we are, in my opinion, probably at the bottom of a capital rotation event where commodities will outperform technology. And we want to be at overvalued states. This is the least risk area to purchase commodities at. And this is tech versus S&P 500. So technology has outperformed the S&P, and it just so aligns with the bottoms of commodity markets. It's at the beginning of a commodity bull market. So we've been bouncing around in this area up here, and I do think that we're at the bottom of that commodity bull market. So Kurt says credit card debt is exploding way beyond 2008 and 2020 levels. If history taught us anything, it's that this kind of spike usually screams incoming economic crash. Time will tell. Well, I don't know if that's exactly what it's screaming at us. Usually what you see is you want to see a rollover of this. If you chart a line through here coming across, that's a pretty big breakout where we've had a big move higher. And just from my own personal experience, and I'm not stating that my personal experience is something that everyone is doing, but I can get a loan on a credit card at 0% APR for 18, 21 months, somewhere in that range. And if I purchase something that's like $20,000, I can put it on a credit card, pay it off over a period of time, and pay zero interest on it. So, for instance, if let's say I want to put new windows on my house, I could open up a credit card. I could put 20 grand or whatever on it, pay 0% and slowly pay it off. It's a way that you can tap cheap credit if you have good credit score and pay nothing in terms of interest rates. It's like cheating. So I probably added a little bit to this move higher recently because of some things that I did. Not recommending that for other people. Mark Berman says the acceleration isn't about artificial intelligence and data centers. It's from EVs, air conditioning, and even water desalination. The reduction in coal use is unlikely to happen until well beyond 2050. So what I think people are talking about, they're talking about an energy transition, and I don't think we're going to have a transition. It's all going to be energy addition. I think that we are going to go up exponentially to the upside When you say exponentially, what I mean is linear goes up like this. Exponential means you go up at some percent increase. So your year-over-year gains continue to go up at a greater rate because it's off of a percentage of what you're using today. And I think we're going to burn everything. I think we're going to burn coal. I think we're going to burn oil, nat gas, everything. And we're going to put nuclear in and put in tons of nuclear. We're going to do all sorts of stuff, guys. Meb says median S&P 500 valuations versus the 10-year forward returns for the S&P 500 equal. So what you want to do on this dot plot here is you want to invest when you're cheap up here. So forward returns is here, forward annual total returns for the 10-year. 10 years going forward. You want to be in the market and buy it when it's up here. You want to sell it when it's down here. And look where September of 2024 is. It's off the chart to the downside. We are out of the 90th percentile of how bad the returns are going to be. So the projected 10-year forward returns for the S&P 500 EW index is projected to make no money for the next 10 years based off of the valuations that we're at today. And our valuations on this dot plot are off the chart in the expensive area. Now, some people will say, we've entered a new regime. We are going to be printing money, and the stock market's going to go up because of the massive amount of inflation. That could be the case. That could be. I'm just stating that it's expensive. That could be the case. Modest Proposal says Goldman strategists calculate a 72% probability that the 10-year treasuries are going to outperform the S&P 500 over the next decade. So they think, so the distribution around our 10-year annualized total return forecast implies a 72% probability that the S&P 500 underperforms bonds, a 33% likelihood that equities generate a return less than inflation, and a 4% probability stocks post a negative absolute return. So based off of the valuations that you see up here, they are projecting that we're going to see an underperformance of the S&P 500 because of the valuations that we are at today. North Star, we've got the U.S. 10-year yields. This should surprise nobody. Rising rates, rising yields, stubborn rising inflation, recession, stagflation, precious metals bull era, stock markets fall over 50% plus over the next 12 to 24 month period. Gold's doubling, then doubles again. I think that about covers it. The thing that is a little bit concerning here is we are starting to break to the upside for interest rates. And generally, when you get above a certain level in interest rates, it starts to impact the returns of the S&P 500 and NASDAQ. Some people say when it gets above 4%, you could see a potential pullback in those equities. And what the market's doing is it calculates net present value, and when you get to a certain level, they start to prefer to invest into bonds over the stock market based off of valuations and the risk-free return that bonds can offer. Now, there is a caveat here. If the market gets worried about the bond market, you're going to see yields launch to the upside. And if gold and silver continue to go higher at the same time that interest rates are launching to the upside, that might be a sign that there's a problem in the bond market. And I don't know if that means like we're at the beginning of the end, and rates just continue on up, or if they can be salvaged to some extent, or if they come in and step in and do quantitative easing. But it's just going to propel gold and silver higher if they step in and try to do stuff with the bond market. It's going to put pressure on the currency then. So if they try to save this, if they try to slow down the move of these interest rates, and they start doing quantitative easing, even if it's backdoor quantitative easing, you're going to see an acceleration of gold and silver. Because what that means is they're printing money and putting all of the pressure that is now currently on the bond market going higher. they're going to transfer that pressure to the currency, and you'll lose value of your currency if you do that. And most countries save their bond markets and destroy their currencies to do it in the process of doing it. JSG, what he does, he puts dot plots of oil in relationship to the commercial inventory level. So it's the price of oil versus the petroleum inventory level. He says the latest comparative inventory analysis using EIA data through 10/16, we're at a 13-month low in the total commercial petroleum stocks, excluding other oils. Implied WTI fair value price of $86 per barrel, suggesting that the current price is $16 undervalued. Now, I had some people make comments like, "Oh, I think Doomberg's, correct, and that oil could go down." That's not what our inventory levels are suggesting. He is giving an opinion that is counter to what we are seeing in the physical markets at this time. Lance says the biggest driver of equity prices this century have come from corporate buybacks. In 2025, buybacks are expected to rise by 15% and will exceed $1 trillion in total. That is a lot of capital that could have been used for CapEx, R&D, acquisitions, and expansion that could have created jobs. So a lot of these are buying back shares, and that is something that drives the returns. There's a lot of oil companies that are starting to do share buybacks. What they do is they had a debt problem in the late 2010s. That debt problem caused a gigantic market sell-off in 2019, 2020. We bottomed in 2020. With oil prices going well above $100 a barrel, they were able to deleverage the company of its debt. They are hitting certain debt level targets, and the companies are buying back shares or doing dividends and maybe even special dividends on top of it. So the biggest driver of equity prices this century have come from corporate buybacks, and that's exactly what these energy companies are doing, and they're going to be a big driver of their own equity prices. Some of them are putting 80, 90, 100% of free cash flow, attributing that to share buybacks. I mean, obviously, they're going to have to spend some money for maintaining production and all that, some CapEx expenditures. But this is a great time to be looking because they're all basically switching from hitting their debt levels to buying back shares at this time. Financelot says Druckenmiller is shorting the U.S. Treasuries with a record-setting 20% of his portfolio. He knows what's about to happen. Interest rates could double from here. So does Stanley Druckenmiller know something Wall Street doesn't? The billionaire investor is making a big bet against the Federal Reserve. So that's what he's doing, and we're seeing interest rates go up and start to break to the upside. Stanley Druckenmiller is looking at the same charts that we're looking at, which is this guy breaking out here. He went major short as interest rates go up. We're looking at the same data here, guys. Kevin posts, I once asked Warren Buffett what he could have done to improve his performance. He said, slept more and gone into the office less. Don't let little data points along the way scare you out of the investment. And this is something that I think is one of the most important thing to understand as an investor. Everyone worries about the little data points that are coming in the short term. The entire big picture eludes them. What I'm going to tell you is you make big money by sizing up the big moves and then not getting scared out of it as you play the big move. So the short-term noise and the short-term little data points is going to try to scare you out of the position. Warren says that's a huge mistake. Patience is where the money is made, the sitting. If you're not aggressive, you're not going to make money. And if you are not defensive, you are not going to keep money, says Ray Dalio. It's a quote. Now, how can you both be aggressive and defensive at the same time? That's really what the question I would ask is, how can you be aggressive but yet defensive? And that's where I think you want to buy things that are undervalued. That is where, and then you want to get aggressive when they're massively undervalued and coming back into strength, where you can play defense and offense at the same time. Your position size is where you're aggressive, but you're doing it at a very opportune time, which is defensive. Nostradamus says the supply-demand balance in uranium cannot realistically happen for at least a decade, likely much longer. Uranium miner valuations are about to go parabolic. Remember me when nuclear and AI. So remember me when that happens, basically. And that's going to be the case. But another thing to think of, what if the supply-demand imbalance is so bad that we find other solutions around nuclear? So, I mean, the supply-demand balance in uranium cannot realistically happen for at least a decade, likely much longer. That means that other potential solutions, maybe we build more natural gas power plants, maybe we turn on coal, maybe we do things differently in the short term to fill that gap. And I think the most likely gap filler will be coal and natural gas. Those are the two that are going to benefit massively in this move. If uranium prices get, really expensive, there might be things that they just say, you know what, let's build a bunch of nat gas power plants. Real economics versus subsidy economics, still not able to compete with all the political and ideological support and cause hysteria, still not able to compete. And what he's talking about are renewables. Clean energy shares have lagged oil and global stocks. Lag. And that's all the subsidies. They cannot make money for their shareholders. They're not sustainable. So we're going to go back and double down on oil and gold, or oil and natural gas and uranium, nuclear. Kikuta says we have companies that didn't exist 24 months ago asking for 100 megawatts of power. If you don't think quotes like that are bullish for nuclear, not sure what to tell you. America will become a major player in the world uranium markets. Our goal is to play is right in the middle of it. And he's talking about Uranium Royalty Corporation. This amended on behalf of Uranium Royalty Corp. So these are the data center share of total power consumption in 2023. The red's the big boys here with high percentage. We've got Warren Pies on yields, now at the level that we thought would cause indigestion. And what he means by that is that yields should begin to pressure equities somewhere around the 4.15%, assuming the backup occurs in short order. So that there's going to be pressure applied to the markets when interest rates get above 4.15, and that's where we're heading. QE Infinity says the 10-year bond yield is soaring today, and it's taking stocks down with it. It's closing in on 4.2%. As the Fed lost control of the bond market, that jumbo rate cut was a disaster, a huge policy error. Tavi says gold is rising as the market begins to price in the likelihood of a Fed forced to cut rates further, despite persistent inflation, in my view. Other metals are likely just waking up to this reality. Gold is now 44% above its 2011 peak, while silver remains nearly 30% below its level from the same period. However, don't misinterpret the situation. Gold is also signaling the potential for another wave of inflation ahead, making the Fed's job even harder as interest payments for federal and local governments are already nearing 5% of GDP. So it's not to mention, China's possible stimulus could add even more fuel to the inflation fire, in my opinion. This gold move is critical to keep an eye on, and then other metals and commodities that typically lag behind it. I agree with that. Gold is our leader. It's ripping. Silver's going to follow, which it is. And then we want to watch the other commodities and metals. They're going to come behind this. And that money and inflation that's coming into the system, it takes a little bit of time to get through the system, but it's coming. Art, I like this one. Total crap from the IEA, International Energy Amateurs. The world is heading into an era of cheaper energy prices as a shift towards electricity use leaves behind surpluses of oil and gas. And he thinks it's total crap. I think it's total crap too. Even if we have the world's electricity generation set to double, I don't think we're going to go down in oil and gas. Guys, go look at Norway. Norway's been selling the most electric vehicles. The penetration of electric vehicles is the highest there. Go look to see what their oil demand has done. It's been flat. So with the most amount of electric vehicle adoption, all that they've been able to muster is a flat demand for oil. That is it. So what they're releasing here goes against what the data we're seeing in the markets. Hogwash. Eric says we have long called alternative energy companies the worst businesses in the world. Low to no margins, few competitive barriers to entry, and usually entirely dependent on government subsidies. This article underlines a common theme: go woke, go broke. We've got Justin Spittler here. He says GLD versus QQQ chart on the verge of breaking a 13-year downtrend. Pretty big deal if this breakout sticks. We've looked at this before of gold breaking downward, because when you price the NASDAQ versus gold in the opposite direction, it breaks downward. But this is breaking upward. Gold's going to start to outperform. The NASDAQ's going to underperform. It's all coming, guys. The big bull market in commodities is right ahead of us. And we're going through the steps of the breakout process right now. This is platinum. Casper says, call of the week. Platinum is about to go on a tear. I've seen enough in the charts that I am very, very confident in this call. And what he says here is platinum is the silent play right now. It's about to clear $1,050 and therefore trigger a $500 per ounce move, is his opinion. Morgan Housel says investing is overwhelmingly a game of psychology. Almost invariably, the best investors are the people who have control over their emotions. Completely agree. QE says when rate cuts don't work and yields go higher instead of dropping, this is one of the consequences of what happens. Let the bank failures begin. So this is the FDIC warns that 66 banks face the possibility of insolvency after being added to its problem list. This is the number and assets of banks on the problem bank list as they're increasing here. This was the big move up before, and here we are heading up higher again. Nostra says they are scam pumping Bitcoin so that CNBC can continue to herd the sheep while continuing to ignore the moves in gold and silver. That's probably true. Herd the sheep into a intangible asset that can absorb paper with digital digits versus the real thing. Robert says the AI-driven electricity demand regularly forecast at an annual growth rate of 2 to 2.5% over the next decade. We didn't have a ton of growth from 2000. I mean, we went up. We've been going up, but now look at the forecast. That's a pretty big move higher, given the 2% CAGR forecast and then the BNEF forecast. So it's the red line of what's coming ahead of us for electricity demand. Electricity consumption is accelerating faster than renewable sources can provide, and so the world, or better said, China and India, turns to coal. Huge jump up in the silver price in China. That is now trading at $37 an ounce in China. Grady says the chart means that this lifetime commodities opportunity is about to go once again into overdrive. This chart means that very good times are coming for commodities. This ratio chart caught all previous big up moves. And now it has a breakout to the upside again here. We just got a breakout. So this chart also shows how historically undervalued small and mid-sized commodity companies are versus the commodities index CRB. Think about GDXJ versus gold, SILJ versus silver, URNJ versus SPUT. So we've got a breakout here, and all of the small guys are undervalued in relationship to their commodities. Really, really good move here for the commodity sector. And Grady says, silver is breaking out again. SILJ is breaking out. TSXV is breaking out. Commodities are in what will be the greatest bull ever seen. The United States dollar should be rolling over soon again. The monetary system is failing, and it's failing fast. The debt cycle is ending. Make sure you make the most of it. And that's where we're going to end it, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. The Mayday coupon code is still active. And that's all I've got for today. So we'll catch you next time. This is Finding Value.